AI startups have captured over half of all global venture funding in 2025. That's an unprecedented $310 billion. Nvidia is up 42%. Microsoft up 26%. The Nasdaq up 22%. All driven by one word, AI. But behind the rally, something is breaking. Analysts from Goldman Sachs, the IMF, and the Bank of England are warning. The AI market now shows classic bubble behavior. Ray Dalio says it bluntly. The AI boom will collapse the moment the Fed tightens. Even JP Morgan's Jamie Dimon compares the current AI hype to the pre-dot-com era. The data backs them up. An MIT study found that nearly 95% of generative AI projects are failing. Only 5% produce meaningful revenue. OpenAI reportedly needs $2,000 per month per user to break even. It charges just $200. Meanwhile, venture capital is shrinking in depth. The number of AI deals is dropping. Investment dollars hit record highs, but fewer companies get bigger checks. That means fragility. That means danger. So how close are we to the pop? And what happens when the fantasy meets the numbers? Let's start with the funding surge and overvaluation. AI startups now consume more than half of all global venture capital. Those billions are flowing into a handful of giants: OpenAI, Anthropic, xAI, and a few copycats. Most of the rest, vaporware. Empty pitch decks with no path to revenue, just buzzwords, hype, and GPU burn rates. The S&P 500 and Nasdaq are at record highs, but they're not being driven by real economic growth. They're being pulled upward by AI optimism and companies with sky-high valuations. The same pattern appeared before the dot-com crash of 2000. And investor sentiment? It's at fever pitch. Fund managers now rank the AI bubble as the biggest tail risk in global markets. It's bigger than war, inflation, or recession. Everyone's afraid of missing out. Cash levels in portfolios are at historic lows. This is what late-stage mania looks like. Now look closer at business success rates. Across industries, from healthcare to finance to media, AI projects are collapsing. 95% of them fail to scale. They fail to deliver. They fail to survive beyond pilot testing. It's not just startups. Even big tech is struggling to turn AI into profit. Microsoft and Google report massive increases in compute costs. Monetization remains weak. Anthropic and OpenAI burn hundreds of millions monthly. They train and serve models that lose money every second. The profitability crisis is real. AI companies run like software firms, but they spend like energy utilities. The economics don't hold. They rely on investor faith, not sustainable cash flow. And faith doesn't last forever. At the macro level, the storm clouds are thickening. Interest rate sensitivity has become a ticking time bomb. Ray Dalio warns that the AI rally depends on loose monetary policy. It depends on cheap credit that's already drying up. The International Monetary Fund and the Bank of England list AI asset inflation as a systemic risk. This is bigger than tech stocks. It's about the structure of the financial system itself. And that structure is creaking. Investment dollars are at record highs, but the number of deals is falling fast. It's the mega round syndrome. Big checks go to fewer startups. That means less diversity, less resilience. When the top-heavy layer cracks, the entire pyramid collapses. These are not abstract warnings. They are the same signals that preceded every major tech crash in modern history. Overvaluation, speculative concentration, profitless growth, monetary dependency, investor mania. Every one of them is flashing red right now. To understand what this means, let's revisit history. In 1999, the internet was changing everything. And it did. But that didn't stop the market from imploding. The dot-com crash wiped out trillions of dollars. Investors confused potential with profit. Today, AI follows the same pattern. The technology is real. The progress is undeniable. But the valuations are detached from reality. The hype is unsustainable. The profitability is nowhere in sight. Even the IMF says the parallels are too strong to ignore. It's not that AI won't change the world. It's that it won't do it at this price. Let's walk through the phases of a bubble collapse. Phase 1, denial. Markets rise. Analysts celebrate. Every dip becomes a buying opportunity. Investors convince themselves this time is different. Phase 2, disappointment. Earnings start missing expectations. AI companies report mounting losses. Layoffs begin. Confidence fades. Valuations stop climbing. Phase 3, panic. The big funds pull out first. The exits narrow. Startups that once raised millions can't raise a dime. Stock prices plummet. Projects get canceled. Phase 4, collapse. Founders vanish. VCS goes silent. The same headlines that once shouted AI revolution now whisper AI overhype. Public trust evaporates, innovation slows, and yet the technology survives. After every crash comes the correction that clears the path for real builders. After the dot-com bubble came Amazon and Google. After the crypto crash came stability and regulation. The AI bubble will follow the same law of cycles. When it bursts, the fallout will be massive, not just for startups, but for entire industries tied to AI infrastructure. Chip makers like Nvidia and AMD will be hit. Cloud providers like Amazon and Oracle will feel it. Big tech firms betting their futures on large models will struggle. Even banks and governments exposed through AI-linked portfolios will face pain. The shock won't be confined to Silicon Valley. It will ripple through energy, hardware, and global finance. This isn't a crash confined to code. It's a market-level event waiting for a trigger. And that trigger might already be loaded. Rising interest rates, shrinking venture depth, slowing adoption, disappointing financial results. The dominoes are lining up. When the first one falls, the rest will follow. But remember this. Every bubble, no matter how violent its collapse, leaves behind its infrastructure. Railroads survived the railway bust. The internet thrived after the dot-com implosion. Blockchain endured after the crypto winter. AI will be no different. The GPUs, the models, the datasets, they'll remain. When the smoke clears, the survivors will be the ones who built something real. The AI bubble isn't the end of AI. It's the end of illusion, the end of easy money, the end of infinite optimism untested by reality. In its place will rise a grounded era of innovation. An era where the strongest ideas, not the loudest hype, define the future. AI will remain, but this time it will stand on truth, not on speculation. It will stand on value, not on valuation. And when that happens, for the first time since this frenzy began, the world will finally see AI for what it truly is. A powerful tool, not a promise. A revolution, but not a miracle. A technology that, once stripped of its bubble, can finally stand on its own.